Fantastic. So a super very warm welcome to our very first SheWealth Collective webinar, which is devoted actually based on the wishes that were expressed in the chat, as well as what we heard from people at events and throughout coachings, all about essential tips and tools to start investing. And so Victor and I will take you on a journey to uncover a little bit kind of some of the myths and most importantly, equip you with some practical tips. But maybe before we start and dive into the agenda, Victor, a couple of words about yourself.
Yes, hello everyone. I'm very excited to be here tonight. My name is Victor Siani. I'm the Chief Investment Officer at Alpian. So basically, I supervise all the investment activity at Alpian. I joined the firm 3 years ago, and I've got more than 70 years of experience in the banking industry.
Wonderful. Huge pleasure to have you here with us, Victor. And to all of you, yes, I'm Olga Miller. I'm a finance expert. Probably with as equal amount of years as Victor. I'm an independent person, as you might know, and I teach money, talk about money, write about money, basically inspire a lot of people to do more with their money, and hopefully also you tonight. So that said, actually, this is not to advertise for my book. Even though just as come out last Thursday, the book is in German. It's about this picture where you basically see this person who is trying to make an investment and somehow having the fear of pushing the investment button. Okay, and for those of you who do not speak German, basically it says now, maybe later. And so I wanted to start with this picture because it is one of the most common challenges that I come across when exchanging with people, which is women tell me very often, I really cannot get myself to push that button. Or when I do, I feel super uncomfortable doing so. So I thought that this would be a great kind of way to lead us into the topics of the webinar, because hopefully after the next 60 minutes, you will not be this lovely lady in my illustration, but you will be like a super strong lady saying, I really know what to do. Okay. So that's the idea here. And yes, if you do speak German and want to support my book, please do so. We're trying to make it to the bestseller list. So I'm asking everybody for support because I need to sell 100 books a week for 3 weeks to make that happen. So that said, on SmartPurse, I don't need to tell you what awaits you for tonight. We're going to shed a little bit of light why investing is essential. Then speak about some of the hygiene factors, what to take care of before you start. Then take you on a journey on a 5-step roadmap, which really should equip you to kind of, learn everything that you need to get going. Touch on the most common pitfalls and errors. So you already saw the person with the button. There are a couple of more, and ultimately conclude this with some very practical examples of investment tools so that you also walk away with something very practical, having a glimpse inside. What do all these tools do? How do they differentiate, etc.? Yeah, does that sound good to everyone? Cool. Please feel free to ask any question in the chat, but also in voice, okay? So unmute yourself if you have any questions. We are here among us. I do not think that we will be sharing the recording of this webinar. Maybe we will do those who couldn't make it, but certainly it's not going to be publicized on the internet broadly and widely. So you are more than welcome to use this as a safe space to exchange, to ask questions, to discuss, so that it is as practical and as useful as it humanly can be. Okay. Well, if there are no questions from the start, let's dive into the first thing, why investing is essential. And here I would be very interested, and you can type into the chat if you want to. do you consider yourself an investor? And let's see what you have to say to that. And you can type, maybe not. Maybe you have a pillar 3A that already is invested. Maybe you have already taken some baby steps. Maybe you already are super invested and just came here to hear what Victor and I have to say or to rip us apart. That also would be not a problem. And here we have some voices, yes, but not a very structured one, not yet. Not enough experience. Would describe myself as a beginner investor. Okay. Yeah, just keep it coming. Just a little bit. Okay. Cool. Victor, you have a view on this, right?
I do.
Afraid of getting ripped off. That's also a very interesting one. And wannabe. Great. So you all have come to the right place. But Victor, what is your view around people being an investor?
Listen, I think that overall we tend to underestimate, how much we invest, consciously or not, because at the moment you have a bank account, you have a second pillar, a third pillar, you have insurances, or let's say you have collectibles at home, you are investing. All these are forms of investment. It's just that maybe you don't know that you're doing it. And I think the point for me about investing is really to make of it a conscious act. You are entitled to it. You deserve your place in the investment world. So unless you want to leave it to someone else, you can make this a conscious act from time to time, like breathing, basically.
So unconsciously, we all are invested, at least those of you who have a pension fund. And mind you, that's probably one thing that is very close to my heart, but it's not the subject of today, but just as a tip, for many of us, our pension fund is one of the largest assets that we actually collect and earn in our lifetime. So the pension fund is being invested for you in most cases. I mean, there is not that much choice. In some pension funds there is. So one thing that you can take away as tip number one from this webinar is to get in sync with your pension fund and maybe have a look. What is your pension fund or employer pension fund provider really doing with that money, right? Mindful of the fact that, yes, you might have a certain level of influence. It might be very limited, but it's still very good to know, right? So we all already are to a certain extent invested. And why is that important? Well, Einstein calls it the eighth wonder of the world. You all already will know it, that the compounding effect, which basically means that you earn interest on also the interest, not just the amount you have invested, is the one thing that helps you to make your money grow exponentially. And in an environment where interest rates have been rising a little bit, but now already not anymore, right? It barely makes up for inflation. In Switzerland, we are very lucky. In other countries, certainly people having money just on a saving account, we're not seeing this favorable red curve for their finances. They actually have been seeing a declining curve. So do not be fooled by the illusion of safety that a saving account allegedly might provide for you. I have here a little calculation for you, right? If you were to invest 100 Swiss francs monthly for 10 years, okay, and you were to save that money, you would make with this calculator, please, Victor, pardon me, it's a UBS calculator, but still, you would have made inflation adjusted roughly 11,455. And if you had invested that money with an average return of 5%, naturally you see that actually what you would have had is a lot more, right? Significantly more. So why we tend to have this tendency of believing that our money is safe on a saving account, it's also being exposed to the nagging tooth of inflation picking away at it, slowly but steadily. Okay, so that is why investing is super beneficial. And Actually, many people feel that they would need a lot of money. And those of you who have already started, you will know that that is not necessarily the case. With today's technology, you can start with fractions of a franc. And my invitation to all of you is, while we are talking here about investing potentially a little bit more money, to also respect the small amounts, because also the small amounts compound. And they actually do compound quite significantly. I have been doing an experiment on Revolut and really only just using a roundup function and investing that money when I was in the UK, which is about a week, a month. Okay, and I only round up to the next pound. Still, over a year, I have accumulated over £500. And that's not me being a lavish spender. Okay, it's me being in London, going on the tube, having a coffee, sometimes having a drink or something to eat with a friend. It's not like on a shopping trip, right? So respecting the small amounts, and we will speak about this when we speak about automation as well, but you do not have to be rich to become an investor and to make more of your money. Now, we already established, right, that basically there is this kind of sentiment of not knowing enough. There are these inherent feelings about, okay, will the money grow? Naturally, your money sits in a magic triangle. The risk that it gets less and not more, the return you expect for your investment, or the safety of a bank account. So it's readily available. You can access it whenever, but then also might bear no interest. And the bad news to you is really that you can't have it all. Okay, you cannot have all three dimensions at the same time. And basically, as Victor will then explain when we speak about the 5-step roadmap, one of the biggest steps is to figure out what type of investor are you and what is your so-called risk profile. So where do you find yourself inside this triangle? Where do you lean? To which angle do you lean more? And to use that then to also structure your investment respectively, right? It is very clear that without risk, there is no return, okay? It's just a simple fact. And I think those of you who have been to more than one of my seminars or webinars, you will know that I always preach that if somebody is promising you returns fast or a great investment that bears almost no risk, it is certainly a fraud. As it has happened to my mom, just very recently, she sent me a thing and say, hey, Olga, can you look at this? There comes a nice email from a company. My mom is active in the medical industry, promising some startup. Nice email. She was almost inclined to do it. And then I was Googling this thing, and I kind of had to Google a little bit deeper. I detected fraud warnings on the internet about that very same company, right? But it was so beautifully disguised. So thankfully, she didn't invest. At least she asked. So the other tip here is to prevent yourself from fraud. Really, either use a bank license provider from Switzerland, or if in case of doubt, please do seek expert advice at SmartPurse. You can always hand us in your investments to look at them. You know that we do provide this service, mostly also just to, help people like my mom so that she doesn't lose thousands of her retirement money on some fraudster. Okay, and these schemes have become incredibly smart. Even I was very surprised seeing that email. They had a whole pitch deck. It was like really well done, a well-done scam. So no risk, no return. But the good news is that, of course, the risk can be influenced and it can be managed. And what does influence the risk when you invest the most? My biggest friend, time. Okay, so time is certainly a huge friend when it comes to continuous wealth creation with investing. Yes, you also can make money on speculation, naturally, and we will see there is a difference between the two, but the time that you have at hand is absolutely essential. Then the second thing, the composition of your investment. So you can look at it like a big blender, right? And depending on what you throw in it, the smoothie will either taste terrible or it will be wonderful. So that certainly is a very important component. And the third thing is actually what happens in your mind. And this sounds potentially super esoteric, and it might sound, you know, to many of you saying, what is she talking about, my money mindset? But I'm going to show you a research from Professor Thorsten Hens from University of Zurich, who has actually studied 200,000 accounts on a large Swiss trading platform, I think over the period of almost 2 years, and has published numerous articles on that, and has come to the conclusion that riding the emotional roller coaster in investing, so really letting your feelings guide your decision, for example, that you kind of feel, okay, I'm going to wait for the best time to start investing, or I'm going to sell because I feel it's a very unfavorable environment, or that you kind of feel, okay, now I've been to the webinar of Victor and Olga and I'm super confident and I'm just going to go for it. Either way, this emotional roller coaster actually costs these investors on the 200,000 accounts that have been tested 5% of performance per year. Imagine. I mean, the average interest rate on a saving account in Switzerland is how much, Victor? How much interest is Alpian paying currently on a saving account?
We are about 1% and 125 for larger amount, but that's on average. I know the statistic by heart because we surveyed all the banks, and the average on a saving account is 0.75%.
Okay, so imagine the saving account giving you 0.75%, and in investing your mind tricking you into losing 5%, right? That kind of shows the dimension of how important it is to have a well-rationalized approach. And the well-rationalized approach, we will just see in a bit, can also be achieved not just with the help of advice, but actually with the help of technology these days. So I'm just going to quickly pause here and see if anyone has any questions on kind of these, why is investing important, and the role of the money mindset, as well as kind of the introduction on risk on this all. Any questions, anyone? Okay, then let's get into it. So now, before you start, there are 3 things that is my personal invitation, right? That are good to kind of think over and think through. First and utmost, many people think about what is the right amount? What is the right amount? There are so many formulas floating on the internet, right? One of them being that you should hold 100 minus your age in investments, in stock investments, right? Personally, I do not believe a big time in formula. I do believe in a sound budget, okay? And what is absolutely essential, that when you start investing, is to have a safety pot, okay? A pot of money that if everything should go sideways or not as planned, or an emergency was to happen, that you kind of can tap into that pot. Why is that important? Well, it will give you a good feeling, but most importantly, it allows you not having to distort your investment approach, right? So for example, having to sell your shares or investments at a very unfavorable point in time, or at very unfavorable market conditions, just because of an emergency. And we will come to the amounts just in a minute. The second thing is, we always speak about these investment instruments, kind of which fund, which tool to use, right? But ultimately, my invitation is it's not just about that. It's as much about what do you feel you are passionate about? What excites you? Which companies do you believe in, right? Which teams do you potentially believe in? Are you excited about artificial intelligence, or are you excited about technology in waste recycling? Or maybe you work in the health industry, or maybe you work in nutrition, and you kind of possess a lot of knowledge based on your profession and the industry that you work in, right? Which already would make you kind of, you know, knowledgeable about certain companies as well as about certain opportunities. Or you want to change the planet and invest in the prevention of climate change, right? So when you start to invest, also being aware what excites you, and Victor will have some great pointers around this later on, is certainly a very good idea. And the third thing is, of course, selecting a tool that actually fits your needs. And I'm going to come onto that as part of this webinar as well, right? Let me just quickly take a little bit of a deep dive into these amounts, okay? The best practice is really to do some form of a budgeting exercise, or at least to make a plan, you know, and calculate how much money you can put aside each month and invest that, or put together a plan and think about your money in 3 pots. What do I need for the very long term? What do I want to have for the midterm and short term? And here, short term would be 1 year, midterm, let's take 3 to 5 years, and long term is your long term money. And certainly you would invest everything that is at least long term. A rule that proved to be very common in kind of finance theory and all kind of blogs is the so-called 50-30-20 rule, which de facto says that about 50% of your income goes to your, you know, costs of living and kind of the stuff that we need, right, including food, etc. 30% goes into the things that are nice, that make the life nice, and 20%, according to this rule, would be the amount that is recommended to put aside and invest for your long-term financial future. Now, this sounds like a very simple rule. If you look at the average spend of a Swiss household, okay, that's according to the Bundesamt für Statistik, right? You actually see here this composition of the household, and you will see that an average Swiss household has a saving rate of roughly 1,710 francs per month. Okay. That said, even the Bundesamt für Statistik acknowledges, right, that this is not very true for a larger proportion of Swiss household. But still, it is fairly interesting to see the household has, right, a disposable income of 6,706. Okay, again, here the Bundesamt für Statistik figure and the saving rate of 1,710. So it's not that bad off, right? In the UK, at the moment, people can save something. I read this on Bloomberg, are able to save something like between £5 to £10 a week, right? Because the cost of living have risen so exorbitantly. So we are still well off. But to bring me to this question around the amounts, you see there are some rules, there are some percentages. Quite frankly, what really helps is to kind of go through your budget, right? Maximize what you can put aside for kind of your retirement, and invest everything that you feel you will need in the future, okay? If you need a rule of thumb, these statistics can help, of course. You also can use budgetberatung.ch. I'm going to type this for you in the chat. Has very good budgeting templates. Berat.ch. They have really templates for 2-people household, 1-people household, separated, divorced, whatever have you, based on these figures that I'm showing you here. But please do not despair that you need to make this a super exhausting calculation exercise. Some people absolutely despair in their Excel spreadsheets. Your financial plan might potentially be outdated by the time you have put all of these figures together. So using kind of common sense also already can help to get you there. And the best thing is to really have a good look at your budget to understand where does your money go and eliminate those money wasters and then get on with it.
Olga, can you allow me to add something just on this chart, because I think it's fascinating. If you remember, we started in the opening by asking this question: do you think you invest? And you made that point about the second pillar, and this is basically the blue square in that chart. So,
Yep.
and what is interesting is that it is in the income part. So you see that this investment, everything that is taking from our salary to go in the second pillar, is a form of income and is already a substantial part of our income, basically.
Absolutely. Which I think combined with the saving rate of 1,710, right? On the overall household income, I think it gets, I didn't do the math right now, but it gets them to roughly the 20, yeah, above the 20%, right? What is very interesting to know, and I'm going to use here the statistics for Sotomo, that 72% of Swiss respondents have said that they do not identify their own pension fund as income. No identification with that money because of the auto deduction. So this blue thing, thank you for pointing this out, Victor. This blue thing, even though it is income and it's part of our, I said, overall assets, right? Because there is a lot you can do with it, is not on our radar screen. Anything more around this? No? Then I'm going to go. What to invest in, right? So maybe let's just do another exercise, typing here in the chat. Just without even thinking huge about investments, what do you feel passionate about? Or what are you very interested in? You know, I'm hugely passionate about waste recycling. One would not figure, but I'm really into that. I absolutely love waste recycling and what technology can do. And I am deeply passionate about technology. It's something that interests me, as well as future of mobility. So anything that's kind of linked to tech, not just fintech. You have me at hello, especially if it helps to solve environmental challenges. So that's kind of my personal passion field. I am, for example, absolutely not passionate about aging demographics. It's not something that I would spend reading about forever. So what are your passions? What is your passion, Victor?
I've got so many that I don't know where to start, Olga. I think you said that I echo your point that the starting point is super important and it varies from one person to the other. And I'm going to give you something I do aside from financial investment. I invest in rare books from the 18th century. I don't think there are a lot of people that does this, but this is something I really enjoy because I see this is the history of mankind that is within these books.
Absolutely. And speaking of alternative investment, I have to admit that my household is a huge Pokemon treasure box, because all of my 3 men are passionate Pokemon players. 2 of them play world championships. So my household possesses by now 8,000 Pokemon cards. And basically we kind of sit on them, and they are, I think, probably a substantial investment. I mean, part of them they have won. I personally, besides kind of the normal investments, also invest in diamonds. I invest in crypto. I invest in startups. So of course this can be very far-reaching. I heard some rumors also, Victor, that you have some Legos.
No, I don't think Legos is me. I used to have a lot when I was a kid, but I made the mistake not to keep them.
Okay, there we go. And here we have a really interested bunch of topics: education, ecology, fashion, right? Very interesting. So my name sister here on the webinar in fashion will be very fascinating to see whether that is sustainable fashion, whether that is new fabrics, commodities, support for women. Yeah, so the whole she economy, animals, nature, architecture. So quite some passion fields coming forward here, which I think is great, because that will be, I think, water on your mill, Victor, later on when you speak about how to select these investments, right?
Indeed.
So thank you, ladies, for this. I'm not going to dwell on this far too longer. We established, right, at the beginning, it's all in the mix. And I just wanted to spend a couple of words around, you know, also in investing, right? There are kind of these trends, these fashion trends. And I personally love to use this example of the cannabis funds that used to be so fashionable and written about in all media about 5 years ago. I don't know if anyone of you has heard about cannabis funds in the very recent time. Nobody has. You certainly might recall then the hype around the metaverse, right? People grabbing land in the metaverse as if it would cease to exist. Completely irrational on a thing that has a 3D model, right? How can there be scarcity of land? I mean, it's programmed. You can program X amount of metaverses. So that was very interesting. There was the NFT hype, right? Now we have the artificial intelligence trend, which is probably more than a hype. And all of these things are wonderful, and we're going to touch on it later, what it all means. Just please note that old-fashioned, boring, broadly diversified investments, okay, with some sparkles on the top, the old-fashioned, well-diversified investments, according to research, make roughly 75 to 80% of your portfolio. So you do not need to search that far, okay? You could get very far making your money grow just with a very, you know, traditional, easy approach as well. Sometimes easy does it. If you want to add excitement, you're more than welcome, okay? But then do it with the right amount, okay? So in that sense, investing also can be equally exciting and equally boring, depending on how you look at it. And finally, the approaches with the tools. From my experience, you have two basic choices. You get very actively into it, which means you select your funds and your stocks and your investments really yourself. Or you get a little bit more comfortable and you get some help, okay? And how would you do this in practice? So in practice, you can search for exchange traded funds, single stocks, whatever other investments, crypto, with the help of different platforms, right? And then go and buy it and put the portfolio together by yourself. You can use a shopping assistant or a so-called online advisor or an online bank, which is a little bit more convenient, but then you pay a fee, or you can use a human that manages this money for you, right? That's what the bankers used to do in the past, right? And what independent advisors and wealth managers actually do. Now, what will inform your choice? If you go and kind of get do-it-yourself, hands-on approach, you need to spend some time with it, okay? I also ask you, do I have the knowledge? It's probably the wrong question. Do I have the interest, right? Because you need to read, you kind of need to inform yourself in order to make an educated choice. The benefit of doing it all by yourself is you can get a lot of control, right? And a lot of transparency, what happens with your investment and what you invest in. So for example, people who are very rigorous about sustainability criteria often are so-called self-directed investors, because it is so important to them and they do not want a fund that might have companies they do not want to invest in. Okay, so that's the self-directed person. If you go with help, then your basic choice is, I think, do I lean more towards the digital, or do I want to have a human that sits with me in a room, right? If you go with a predominantly digital experience, that doesn't mean that you are talking to an avatar, right? It just can be something that actually is online available, where you potentially communicate with the specialists online, etc. Then you usually are on the cheaper side. The pure human experience, so somebody sitting with you with your investment, will on average be more expensive, right? And they are these hybrid forms, right, where basically, for example, at Alpian, but also, for example, just to name another, at Selma, right, you can speak to an advisor, speak to a professional when you need to. Okay, so frame your mind in which camp you are. Why is that important? It's important because it informs your choice of tools, as we will see later on. Okay, good. I'm gonna just spend one last minute on this. One of the very common mistakes that happen is that when people invest, they do not know the difference between actively managed funds and passive funds. So active funds are the funds where a fund manager or a fund management team makes the stock and investment selection. Okay, so they go and they say, we pick this company and this investment and that investment, and then they take beautiful care of that fund. Naturally, this expertise and active management has its price. Okay, and then they are so-called passive funds. So passive funds are also put together by human beings that compose a tracker or an index. That's why they are called index funds or exchange traded funds. And once this index is established, it basically tracks what it is supposed to track. And it's like an automated tracking, right? And because in these so-called passive funds, the humans do not need to intervene that much. These index funds and ETFs are incredibly cost-effective vehicles. They are a whole bunch of themes and options how you can use them. And Victor, here you are the specialist on this, right? Because you dig into the ETF universe for, I don't know, day in and day out. But they are very easily to invest in instruments. Now, when would you choose an active fund? You would choose an active fund maybe because it invests in some great opportunities that otherwise are not accessible to you. Okay. You would choose it potentially because it has made such an amazing performance. Okay, so that it justifies the fees. I can give you maybe one good example. There is a wealth management office in Zurich that manages the money of a big family in Switzerland, and they have a fund or an investment, multiple investment vehicles where you can participate and invest alongside the family. Okay, so this wealth manager, basically, you invest together with them, okay, at fairly reasonable rates. That is a good example where you potentially would be willing to accept an active fund, okay, but not just because there is a human being. Otherwise, the passive strategy is always better. And we saw before this whole thing around the metaverse and the cannabis funds, etc., right? As well as the performance of these active funds. And you see here Morningstar studied this, but there are numerous studies on this. They have found that over a period of 15 years, the success rate of these active funds was roughly 20%. So only 20% managed to be better than the passive funds across all asset classes. So I think that that is very interesting. So I really encourage you, if you have investment, have a look. If it is expensive or is called active, then it is an active investment. Okay, the passive instruments usually are called something with index or exchange traded fund, which makes it easily recognizable. And with that, I'm gonna hand over to you, Victor, for the 5-step roadmap, and have a look in the chat if I can answer any questions in the meantime.
Thank you, Olga. I think the goal of the next session is really to leverage on what Olga shared with us and go sometime a bit more in details, share as well what our clients are doing. I managed to get some statistic because I think it can be of relevance here. And yeah, try to devise something that is actionable. And I would start with this question because it's all about building an investment strategy. Why do we need an investment strategy? And the way I see it is it's a powerful tool to try to filter the noise from the information. We discussed about all we could invest in the beginning, and you also put something in the chat, commodities, architecture, stocks, ETF funds. And just to give you some number, today for a Swiss investor, the options are almost limitless. Some platform like Swissquote brag about the fact that you can access 3 million financial instruments with them. If you're interested in digital currencies, NFTs, cryptocurrencies, there are roughly 20,000 of them. If your thing is to buy fashion or collectible bags, Hermes, the boy from Chanel, whatever, and you're in the auction houses, the average number of opportunity in an auction house is 10,000 per year if you take a regular auction house in Zurich. So my point here is that the options are limitless, and at some point you need to make some choice. And for me, this is why an investment strategy is there to help you find really the gold nuggets and let the surrounding soil apart, and also avoid some of the scam like the one the Olga's mother has been proposed. So that's the point of an investment strategy for me. And if we move to the next slide, I don't know if I have control, Olga. Yeah, perfect. I'm going to start with the first step, which is very simple. You need to know what you want. As a chief investment officer, you can imagine I'm having a lot of discussion with clients, random individual when I go to an event, or even friends and family. And you can be sure that in 1 out of 3 discussions, someone will come and ask me almost in a confidential tone, Victor, what should I buy? And this question always amazes me because finance is probably the only place where you can ask this kind of question. Just imagine yourself going to a pharmacy, a supermarket, and you just grab the person and you say, hey, what should I buy? I think this question would at best sound very awkward. And at worst, you can end up with something that you didn't need. And I think the antidote to this is really to have a plan, because you can always count on a banker to have an answer to that question. That's, I think, the point I'm trying to make. So what I mean by a plan is really 6 questions for you to answer. The first is really to be clear about why you want to invest. What is it behind that you are trying to achieve? Is it like you want to save and get a bit more to go on a trip? Do you want to retire earlier? Do you want to finance the purchase of a home? Whatever, try to have this in mind. Then try to guess what is the amount that you need, and over which period of time you will need this amount. So what, how much, and when. And the time is very, very important in that equation, as Olga pointed out. Of course, there is an element of risk, and here the goal is try to understand how much you can afford to lose. You've put aside the money in your iron reserve for your retirement. This money you are ready to invest it, but maybe you don't want to risk it all. So it's important to know how much how much risk you could take. And then of course there is what you don't want to invest in and what you are interested in. We discussed this already. And this question, if you go in any discussion, even with a banker that start talking about a wonderful investment opportunity, you can go back to your plan and say, no, sorry, it doesn't fit my plan. This is not suitable. It's nice, but not for me. And already you can narrow down the investment universe. So step one, know what you want. If we move to the next slide, the step two is to know what you're made of, basically. And Olga mentioned this, all this behavioral bias that we have that can cloud our judgment, that can push us to make the wrong decision. It's super important. The way we're going to try to do this, if let's say you want to open a relationship with Alpian or any bank, is through a questionnaire where we try to know what is your appetite for the risk. And at the end of the day, we try to put you in a box that goes from conservative, balanced, and very aggressive. Conservative means that you're not ready to take a lot of risk. Very aggressive, you want to try something that is exciting, basically. And behind this, it is an important question because you get a mix, as Olga mentioned, that is comprised more or less of very either safer investment like cash and bonds or more risky assets like equity, digital assets. Before we go on to the next slide, I'd just like you to imagine, according to you, in which of this bucket do you think you fit? Just take 1 or 2 minutes. You can write in the chat. But for me, it's important that you try to do this exercise just from your point of view. Great. We have one balanced. Balanced. Great. Oh, wow. Anyone conservative or aggressive? Ah, conservative. Great. So how do we know
These
if
ladies already have been through a lot of, weekly coaching sessions, some of them. So we talked about this stuff. Yes.
That's great. So let's see if that's true, Olga. This is now the key question, and we can move to the next slide. And I'm going to talk a bit about how we do this at Alpian. We ask the regular question to try to see where you fit, but then we also play this kind of lotteries game. And here I'm very generous tonight. I'm offering you 2 options. Option A is a lottery. You can lose 2,000 Swiss francs with 50% chance, and you can win 4,000 with 50% chance. That's option A. Or you go for the most secure, which is that you can win 1,000 with 100% chance. And I want you to picture the answer in your head. And if you've done a good job, at least it should be coherent with the first slide. So if you say that you were more on the conservative, normally you should pick the answer B. If you picture yourself as an aggressive investor, you shouldn't be surprised if you picked option A. And there are a lot of behavioral quiz that you can do to try to know exactly where you fit. And even if you've never invested, you can try to guess how you would react thanks to this kind of quizzes. If we move to the next slide, what I'm trying to say basically is that there are always a gap between the reality, so the fact that we can win and lose, and how we perceive these gains and losses. And the green shape is the average investor profile. So we tend to be more sensitive to loss than to gain. When it comes to gains, if I give you 1,000 Swiss francs, you're going to be excited. But if you already have 1 million and I'm adding just 1,000, then it's not going to excite you. So we have all this flow that makes that we are not rational investors. I'm going to throw in the chat some quizzes you can take online, not from Alpian. I'm not making any advertisement for other provider, but I just thought they were very good, quizzes that you can play with, or maybe Olga, if you have some, I'm sure you can add them on the chat. But knowing what you've made of for me is key, and I'm going to illustrate something with the next slide because we're doing this on a daily basis with our client. On the left-hand side, you have where our client thinks they belong. So which bucket basically they think they fit into. And for example, you have 16 of them that are in the balance bucket, which was the most popular on the chart. But if you look at the reality, after we've done the quiz, we see that the percentage basically are different. And for us, it's very important because really what we want at Alpian, what we care for is that you are in a bucket and you have a mix, because at the end, what we do with this profiling is recommend an asset allocation, a mix, is we want this mix to be suitable for you. And what we've observed, we launched, in 2022, we have now 2 years of experience, is that because we do this better job at profiling people, they tend to go through all, the market turbulence in a better way because they are at the right place. So step number 2 is really know what you're made of and use tools if that can help you to figure this out. If we move on, the third step is to know what attracts you. And as we said, the starting point doesn't really matter whether you come from, a passion on commodities or, you like fashion or whatever. It's great because this is how you get into the world of investing. But you have really two camps. You have the specific opportunities and you have the camp, which is more the diversification. And to give you some example, on the left-hand side, you have Bitcoin, NVIDIA, sustainable food. These are specific opportunities. Or you can decide, look, I'm agnostic, I'm interested in stock, and maybe I want to invest in the 10,000 largest companies in the world. At Alpian, we are more in the camp of, and this is what Olga explained, that boring is beautiful. So if you don't know where to start, it's better to save on the diversification camp. And to give you some insight again from our client bases, I think we can take pride of this because it's really this core satellite, core opportunistic approach that Olga was referring to. We have, if you look at the people that invest with us in an advisory, which means that they can do whatever they want and we give them some advice, 91% of the assets ends up in core investments and 9% into more specific opportunities. And this is really matters. I think if we go to the next slide, Olga already touched on this, but for me, it's you can have both. Here, I'm just highlighting the pros and cons of each one. Specific opportunities, the advantage is that you can win big if you get it right, and it's super exciting. But you can also lose big potentially if you are wrong. And you need either luck or talent, time to do your own research. Whereas the diversification, the trick is really that you get it right more often on average. You face probably fewer risk. But it's a bit boring, let's face it, sorry, and you will win less if you get it right. That's a bit the point. But again, here I'm very, after 17 years of experience, and I also apply to myself what I preach, it's better to save on the diversification. It's better, sorry, to err on the diversification side. Just to illustrate and to bring my point home, the next slide is a study I did on 400 ETF that are thematic, right? So I give some of the name there, blockchain ETF, metaverse, solar ETF, you can play diversity, aging population that Olga likes so much. All of this, you can do this, you can invest in those. But if you compare the return after a certain period of time versus if you had invested that money into the 500 largest company in the US, you see that there is a big difference. On average, these themes tends to be more expensive, or at least the way the financial community packaged them. Let me take the blame for that, right? 84% of this thematic ETF underperform, so it's a large number, and the gap versus if you had invested into the largest company is also big. It's close to 10% difference. So it's not to say that themes is something you should avoid, but I would say if you know the theme better, that you probably, if you're coming from that industry, you know the themes better than investment professionals. So it's probably best not to take some of these prepackaged funds, right? Do your investment research, use the edge that you have. And as Olga said, keep this, in a reasonable amount, and maybe put a more substantial amount in the boring camp, because this is on average how you're going to win the race over time. So this is step 3, really try to know what attracts you. If we move to the fourth one, I'm going to just go quickly on this because Olga mentioned this. Know what it takes. I think investing requires time, will, and experience. It doesn't mean that if you don't have the 3, you can't invest. It's just that then the setup option to do it might be different. And on the next slide is a bit of a repeat of what Olga said, but I think it's good to reiterate the message. You have, I've got one more option versus Olga, which is the middle way. So either you do it yourself, or you delegate, or you can find a compromise. I can say that not a single solution is perfect. They have their pros and cons. If you delegate, you have some time to accept, especially if you go with a robo-advisor, a form of standardization. You can't control every investment decision. It's an act of trust, but it also has some advantages. It's turnkey. You can focus on what really matters to you, and still have your money invested. On the other side of the spectrum, do it yourself. It's very easy to do. You just have to open a brokerage account. You're 100% in control. And it's also true that, any bad decision is really comes from you, right? So the responsibility is yours at all time. And I would also point that it's not always necessarily cheaper, especially if you take into account the 5% underperformance that Olga touched about, right? So sometimes we go there because it looks cheaper, but when we see what we leave on the table, it's maybe not the best option. So here it's really for the adventurous people that have the will to do it themselves. And you have the compromise. And as any compromise, it's the best or the worst of the 2 worlds. But I think it's something worth investigating if you want to start. You're not 100% sure where to start. You would need a bit of push, a bit of guidance, but you still want to try some solution exist. And basically at Alpian, we don't provide the do-it-yourself solution. We are more here to provide guidance. So we have 2 solutions, one that we call Guided by Alpian, which is the second, and the third is Managed by Alpian. And we see, again, to give you some insight from our client base, that they're equally popular. Some really don't want to to spend more time. Other I want to experiment, and Guided by is more for them. But yeah, it's in equal proportion. If we turn to the next step, which is the 5th and final one, I think at some point you need to start somewhere, and I would say it's fine to start when you have 80% of the information that you desire. You will never get 1% certainty then one investment will work. You have to cope with uncertainty. But the good news is that we learn investing by doing. And I can tell you that I'm the best example of this because I don't have any degree in finance. I come from investment research. At 24, I was still in London, working in an institute for cancer research. And then I decided to move to investment. And I became later, today, chief investment officer. So and I learned this by reading books, by doing myself, by experimenting, that there are no better school and it can be really fun. And as Olga pointed out, you don't have to start big. So step 5, know when you start. Don't stop finding excuses. At some point, you need to give it a try. So if we summarize those 5 steps, sorry, on the next slide, start to know what you want. Basically, it's don't let someone else come with a plan for you. Come with your own plan, and it only takes 6 questions to answer. Know what you're made of. Take some quiz, because 80% of the mistakes you're going to do later originate as well from your own behavior. Know what attracts you and try to, if you don't know, go for the more diversified borrowing option. Step number 4, know what it takes to just have a very candid conversation with yourself to have what it takes, the time, the will, the experience. Otherwise, you go for one option versus another. And 5, know when to start. Basically, don't overthink it. I hope Olga won't mind me saying this, but I think a month of experience is also worth a webinar, right? What you will learn by doing is super important. And I'm going to step here. This is like a 5-step roadmap, and I'm happy to take any question, or we move on to the next section.
Yeah, let's move on to the mistakes, maybe. And I think many of you were tapping saying, yeah, I don't know enough. It's not very structured. And I think that's probably part of the problem that we all are battling with. It's not very structured. And you don't need to know everything in order to get going. By the time you figured everything, nobody knows everything about money, okay? Victor, myself, we all make mistakes. So the time, I'm coming again on the time, the best friend that you spent by learning and learning and learning your money already could be working. And I seriously mean this, right? So maybe we learn the most also out of other people's mistakes. So Victor, here, your biggest personal investing mistake.
I can safely say that it's not having invested more earlier and in a simpler way. I started too late, not enough. I started experimenting stuff that are too complex. I could have just started simpler. And today, the good news is I'm avoiding this for my daughter. The moment she was born, I said, I'm going to put some money in a very boring way and see how it worked out. And 8 years later, I'm very happy to have done this choice.
Okay. And then some other pointers, a couple.
Listen, in the interest of time, here is more like what I've learned by doing. I'm going to tell you something. I wrote a free book that you can find on LinkedIn if you want to go really in the how to pick particular investments. But this is in a nutshell some of the mistakes I could do when sometimes I was presented with very shining opportunities that were not that shiny. And I made those errors, like to confound new with different, popular with profitable, plausible with true, accessible with liquid, scarce with sought after, and economically viable with investable.
Okay. Cool. So my biggest personal investment mistake was not to start too late, but I started with thematic investments, or the banker at that point in time, mind me, recommended thematic investments. Infrastructure, luxury goods, I still recall it very well, and not something broad-based. So after 20 years in this infrastructure fund, I had actually made a return of 313 francs. Okay, because the fees and the exchange rate have eaten it all. And I knew, not after 20 years before, that this investment was probably not like the greatest thing. And still, my own laziness and kind of dealing with it prevented me from cutting it. I always had this hope, it's going to do better. Something is going to happen with it. Something miraculously marvelous, which was when I finally pulled the plug, okay? So, you also can start early and then with these too costly investments end up in having nothing. So summarizing what Victor just was saying, certainly not starting at all. I do not regret these mistakes, right? The second thing is really watch your fees. That's why I was going on about this active funds versus passive, because on my own painful experience, I have learned what it can mean, right? The third thing that I can point out is, if you want to make lots of money fast, you need to assume the respective risk. And yes, then maybe you end up in crypto, right? Because it has huge movements and you can buy and sell. You might end up in day trading like I have, right? It is possible. Or you go at this with a longer time horizon. So knowing who you are, but if there is a mismatch, this is where things will go south, okay? All eggs in one basket, I think, is very obvious. And then once you have your stuff set up, changing your strategy, they are these people. And also on kind of the trading platforms very often that even incentivize this, right? Buy this, buy that. It's what Victor meant before with new doesn't necessarily mean different, right? That end up trading so much that the fees eat away at it. So in its core, investing can be a very relaxed, even boring affair. And I wanted to show you a couple of the tools as we've been dwelling on them. First and utmost, right? Super easy ways to start. So depending on how much money you have, not every online helping tool you will be able to start with it. So here you have kind of a different map that you will not find on Moneyland, which is, you know, different kind of tools that provide online advice, right? I'm not talking about their quality. It was more about their starting amounts, right? You also, of course, can start with your Pillar 3A, as already said, and use a specialized tool for that. But there is no excuse not to get started. That's probably not very structured, but it's certainly helpful, because if you want to get started with a very, very small amount, I'm talking, you know, 1 franc a day or something like this, then naturally you need to select a tool that allows you to do that. So that being one thing. For those of you who say, you know what, no helper needed, I'm going to go at this self-directed, so I'm going to pick my own investment. You need two things. One is some form of search comparison platforms, right? So in the ETF space, probably the two most prominent one are just ETF and Swiss fund data. And then you need this broker. The broker is there to basically hold your deposit and hold your investments. Okay. There, please do watch for the costs per trade, which means when you buy and when you sell, because as Victor already was saying, it can accumulate to quite substantial amounts, especially if you want to invest monthly. Okay, then this might not be the best strategy. Then you might need to save the money and invest every 3 months. If you are looking for comparison, I always can recommend Moneyland has good comparison. People often ask, so how does this self-directed approach look like? I have accounts with Swissquote, with interactive brokers, with a tool called Wolfix. Let's not get into that. What can you imagine? How does it look inside? So you have also the view of a SheWealth portfolio, okay? So you see here one of my portfolios that is in single stocks and one ETF only, yeah? You kind of have this view, but then to buy, and these are not my investments, it's just to see the watch list, right? You really have to go company by company. You can compile watch lists, you can read a lot of analysis. So this tool provides all of this data. It's not difficult to use, but is what I meant before, you need to spend the time with it, right? Especially if you are thinking about potentially buying into an industry or going into an industry that you are not that familiar with. Like in my example, it was an eye technology provider. I just thought it was very interesting what they are doing. So I had to do a lot of reading around this industry to make my sense. The advantage you have, you get all the info from the analysts. So if you are into this, it becomes, for me, it's like my Sunday read, right? I sit on Interactive Brokers and read and research these companies because I like doing that. It's like other people go jogging. If that's not you, you still can use these tools, but you might be better off if you use a helper, right? That already does or helps you to make some form of a selection and puts together this pie of investments for you and also manages it respectively. Two different approaches. You need to do you, but both of them will lead to a result. Okay, so it's not that one replaces the other. You also can be like me and have both. I have my boring investments kind of with these online tools, and I go on Interactive Broker to get my excitement when I want to do more on stocks, or I, of course, also on crypto and on alternatives, but I use different tools for that. But I think you kind of get the picture, right? So my base, it's with two tools, and then I have my excitement where I am having a lot of fun, right? So on the infrastructure, which tool to find out? Number one, what's the starting amount that you need to start with, right? Number two, what type of investments do they offer? Because maybe if you want to go, I don't know, into something very exotic, they might not have it. How big is the provider, right? Do they have a banking license or not? A Swiss regulated banking license is what matters to us in Switzerland. How much are you paying? And then please also do not underestimate, I cannot say it enough, the experience with the tool. If you hate the tool, you will hate your investments, okay? I think those of you who have been to weekly coaching, we were looking at some of these tools like in depth, and you know, ultimately some people decided to swap because they said, you know what, I'm never going to come to terms with this. So my recommendation is form your mind around what's kind of right for you, and then first go and test it out. Nobody is telling you that you need to put 100,000 francs into one tool straight away. You can make the experience, or you can work with the demo account for a while and see if this actually speaks to you. And only when you're comfortable, then, you know, you will naturally feel the trust will start building, that you actually trust the tool enough to put more and more money into it. It was the same for me as well. With none of my investments, I started putting all of our household money into it. It's always kind of a test and learn approach. And that's completely normal and perfectly right. I'm just going to pause here to see if, Victor, you have any add-ons.
No, not at this stage. Thank you, Olga. I would be
Okay.
curious to see if we have questions.
Maybe you can check in the chat. I'm just going to explain this last thing.
Yep.
One very frequent question that I get is people ask, should I invest a larger amount at once, or should I get at this staggered, like, for example, every month? And it depends. And Victor, please correct me if I'm wrong. But research suggests that if you have an amount of money and you already have it, okay, so it sits in your saving account, investing it is more beneficial than staggering it out, because if you stagger it out across, let's say, a year, your money does nothing, right? It kind of sits there and is sleeping on the saving account. Or you might do 2 or 3 kind of tranches, okay? Naturally, if you do not have the money, then you will invest monthly. That's one, because there is no other choice. The other school of thought is that staggering the money out will give you kind of a cost price average. So you do not buy at a high or at a low, you kind of get an average price. Mind you, in the very long-term effect that we are talking here, 10, 15, maybe 20 years, if you stagger the initial investment out for a year or not, will not make such a significant difference. So depending on where you are and also what your risk sentiment is, but do not leave money lying around for too long, because then your mindset already sits kind of in the mantra of market timing, and that's not where we want to be. Remember that lady from the start, now. All this time is costing you, right? Because you are talking about a long-term investment here, not speculation. And finally, how can Alpian help you? I think, Victor, you already touched on this, but maybe you could quickly say how you select the investments, because that might be helpful.
So thank you, Olga. We have two forms of mandate, basically. One that is really if you want us to take care of the money, one where you can invest and receive some guidance, experiment. Behind it's ETF mainly, so we are really in the passive camp, very mindful of cost. We avoid unnecessary risk or unnecessary cost, basically. And each ETF is handpicked by our team. So we make sure that they fit our criteria in terms of liquidity, in terms of how well they track the indices that are supposed to track. If basically the behind you really have the stocks and it's not a kind of funky product. So our team is really dedicated. We do this every day to make sure that what we put in your hands at the end of the day is of good quality. And we also come, of course, with the allocation, so how to put these different ETF together. We have an offer. I have to mention this, although what I really like about this webinar is that it's really your neutral space to get information, to exchange. I'm just putting it out there in case you are interested, but I want you to know that the philosophy at Alpian is not to push you with product that you don't need. If you are interested, you can reach out, have a call with one of our advisors. If you are not ready to invest, you can still benefit from interest rates. Our philosophy is really to make you comfortable. In case you are, we have this incentive if you are interested, and you just have to put that code in the app during the onboarding. Olga, you're on mute, I think.
Thank you, Victor. And while you are giving us feedback, because it matters to us, we want to make this useful. I just wanted to mention that next Monday, we are starting an investment simulation game, where basically you will have a whole huge stock universe and ETF universe to pick from. We're going to do it together with a partner called Ikati. Without putting down any money, you can try out whatever there is. Ikati is not an investment tool. They are a game provider. That's what they specialize in. So, or a financial simulation provider. So you do have the opportunity to try anything out. And we're going to have weekly calls where we're going to discuss. And I still hope that Victor will put his portfolio into the game tool. I will put my portfolio into the game tool. We're all going to play. And hopefully this will give you an environment where you can try all things out, experiment, okay? There is no right or wrong. There is nothing to be lost. The only thing that will benefit is we are putting out a community challenge. So the more people participate, it's completely for free, the more trees we're going to plant. And I'm just mentioning this because as you all came to this webinar, maybe this comes in handy since next week we're starting with this. So I'm going to put it into the SheWealth community chat. You will read on it, or you can read on it on SmartPurse, social media posts, etc. Completely free of charge. And I think this is going to be great and fun activity for all of us to kind of get into it. Okay, so here I am with kind of our feedback. Those of you who want to give us some feedback, please do so. And let's move over to some questions. Ladies, the floor is all yours.
And I see we have a couple of them already, Olga.
Yeah, cool. Do you want to pick one from the chat or shall I?
Yeah, I
Sorry,
think the first one in order was, I guess you can do a mix of both options. I guess, Karina, you were referring to the do-it-yourself versus the delegate, and I think the answer here was absolutely. And Olga is a proof of that. Even myself, for my own investment, I like to play on my brokerage account, and for my daughter or for myself as well, I have a kind of more boring portfolio delegated. So absolutely.
Absolutely. And then I'm taking the second one. Can you move an existing 3A pillar to any place to invest it differently? Yes, absolutely. But it has to be another pillar 3A solution. Okay. So Alpian, for example, doesn't have a pillar 3A solution. So you couldn't move your pillar 3A to Alpian. That would not work. But to any other pillar 3A solution, yes, I have already moved mine multiple times. No problem at all. Then maybe the next one is for you, Victor.
How much of a total wealth would you recommend investing in one title? Listen, here it's really depend on your how much risk you want to take. I would not advise going too big on this. If you just to give you some number, if you take the variation, if you take what you invest in one stock, the average variation, over a 1 year period can be, around 20%. And the worst, case that we saw during the financial crisis, it can go down to 50 and even go burst. So you're taking big risk here. And I wouldn't go big unless it's something for example, it's your own company stocks. Yes, and you inherit some stock options, sure. But if it's just for you, I would not go, I don't know, if I have to put a number on this, not above 2%, and even it's generous. Would you have a different view on this, Olga?
How much was it, Victor? 2%?
2%, yeah, maximum. If you don't know what you do precisely, right?
On one title, you mean?
On one title, right?
On one title, yeah.
NVIDIA of total wealth, huh?
Yeah, no, I wouldn't put more either. Really go with a broad base. I think if you know you are starting out. Definitely. Then we have somebody's asking what is an ETF? There are no apologies needed to ask that question. It's exactly one of these funds that basically tracks, okay, an index or a tracker. So you take, for example, 20 companies, you track their price development, you build this automated tracker, and the fund, basically with the fund, you invest in these 20 companies and their price development. Why is it called an ETF? Because it is also, this fund is also traded on the exchange. Okay, that's why it's called the exchange traded fund. Now, why is that a thing? Because many funds that are out there are not traded on the exchange. They are actually traded once a day by with the fund manager. So these so-called exchange traded funds differ from the other index funds in the sense that they are traded on the exchange. Hope I managed to explain it in kind of the 2 minutes that I had. Otherwise, please direct message me. Good, and over to you, Victor.
I like this question for long-term investment, 10 to 15 years. If we invest to well-established company like, for example, UBS or Johnson & Johnson, as the stock price is already high, would it bring much returns? Or you advise to look at mid-sized company with a promising pipeline? I think here I would make a distinction between the size of the company and the price at which you can buy it. You have large companies that are overvalued, meaning that you're going to pay a high price to acquire them, but it also works for smaller companies. And you have large companies that you can buy at a discount, and similar for smaller companies. Just for example, to take UBS, UBS is a well-established, but I'm sure you saw what happened this year when they acquired Credit Suisse, and I think it was a huge bargain for them. that then push the price higher. So I would say there is no correlation between the size of the company and the return. And to also answer the question, yes, you can consider a mid-sized company to push a bit more the performance of your portfolio, but it also goes with higher risk. Although in the past years, we didn't see this type of investment really overperform, sorry, the larger company.
And I can add to that there is some research that actually touches exactly on this question. And in that research that I have read, I think the mid-sized companies over the long term performed better. But I completely agree with you, Victor. I mean, that's just one research that I have read, right? So it's not very representative. Okay. Where can we read more about possible stocks to buy without having an account with interactive brokers? I mean, usually you can watch SRF Börse for those of you who speak German. I personally read Yahoo Finance. I read a little bit of Bloomberg. What else do I do? In German, I read Cash. Okay. And sometimes, in all honesty, it's not only that much about reading, it's also just observing your environment. Some of the best investment ideas come from daily life. Every product we have, whatever trend we see, usually is represented by a company, right? And in my case, also, I have to admit, I also do a lot of Googling and AIing, not on ChatGPT, but on Perplexity AI, just to kind of form a broader view. What sources do you use, Victor? I mean, you sit in a bank, you have different sources, right?
I've got, of course, a lot of sources, but there is one podcast that I love. And when I go, to the office working, I like to listen to it. It's called In Good Company. And it's basically the manager of the Norwegian pension fund, which is one of the largest in the world. And he has access, the manager, to basically all the CEOs. And every week he interviews one of them. So you get to hear the CEO of Microsoft, the CEO of McDonald's, whatever, all the company that they own. And it's not about like, they like to discuss with the CEO his view, how the company is set up, what are the advantages, and you learn a lot. I love this.
Very cool. Perfect. We shall all listen. And then finally, somebody is asking here, what is the Stock Sister Challenge? That's the investment game that we're going to play completely online, where you will be selecting your own stocks and your own ETFs. And it's playing with real market data. So it's not like a fictive thing, okay? It's real market data, what's going to happen, but you play it with not real money. So it's a perfect, basically with fictive money. You join the game, you get allocated, I think it's going to be 50,000 or 100,000, and you have to pick your stocks and your ETFs and whatever and manage your own portfolio, and we shall see who's going to come out of it as a winner. And why did we call it the Stock Sister Challenge? It's actually for two reasons. You might know about the crypto bros, okay? All these images showing the guys of fintech, right, in social media. So I thought, you know what, if they are crypto bros or fintech bros, they also can be stock sisters. And the other thing is that I would love to inspire more men to invest like women, risk conscious, thoughtful, with sustainability and broader society in mind. So we are inviting men and women to join the Stock Sister Challenge, and we're going to reveal what we mean by Stock Sister. Okay, so that's what is behind it. It's going to be a lot of fun.
Cool. I share the same wish, Olga, really.
There you go. So see, but you are on holiday, never mind. And then we have one last one. How important is intuition when investing? Is a good one.
Intuition is basically what you start with, right? When you are not structured, then over time, at least this is my perspective, then you build, a way to assess every investment opportunity. I talk about this book I wrote that is called, What a Banker Won't Teach You. This is really how I think when I go through investment. And now that this code is a bit embedded in my brain, I can let intuition run again. So for me, it's super important. But you also need some method at some point.
Yep. I think that the broad base, look, my first investment that went so, right, was so unfavorable. It was rational. It was recommended. It turned out to be an absolute non-event, right? Now, I didn't lose any money, but I also didn't make any. De facto, I lost because for 20 years, this money could have been invested into something far more profitable. So I think kind of having your broad base, and then on top of that, playing with intuition with an amount that you are prepared to lose. I guess it shouldn't hurt you too much if you lose it. I mean, many people who know me know about my wonderful power cell stocks that are doing nothing. I think they hit ground zero by now, most likely, or almost. They're very close to that, right? I mean, I didn't lose a lot of money on them. So it was a risk I was willing to take, right? Now I have another outperformer, Solar Edge from Israel. It's not getting anywhere. So yeah. But then on the other hand, having invested in NVIDIA already some time ago certainly was a great intuition. Nobody told me to pick NVIDIA, right? I was observing my kids and doing some reading. So I think you have to do it with the right amounts. Then there is room for both. On my retirement money, I will not take any. I just go with the broad-based boring thing. I hope that answers the question. Right. I hope we covered all there is. Thank you so much, everybody, for giving it a little bit more than envisioned for this webinar, for your active participation, and hopefully see you in the WhatsApp group. Those of you who come to SheWealth meetup on the 5th of June, see you in person, or otherwise meet you. Usually we speak Monday evening, right? So with that, have a wonderful time, and hopefully to see you at the Stock Sister Challenge. Let's show it to the bros. And thank you, Victor, too, for this amazing
That was a
webinar together
pleasure.
with you.
Likewise, have a good evening.
Bye-bye.